Michael Kramer, pleasure to meet you. Looking forward to chatting with you. Welcome to F.A.C.E.
I'm here. Thanks for inviting me and letting me join this morning. I was just enjoying and listening for the last 15 minutes. So
Oh, well,
it's great stuff.
great to have you. And when I was booking this, I didn't even really think it was Friday the 13th until you brought it up.
I don't know. I got a little bit nervous. I saw your boxing sort of image on Twitter, and I'm like, he's setting me up on Friday the 13th. I'm like, let's see how this goes.
Yeah, but those skills would be to have your back, Michael.
I know. I'm kidding.
All right, buddy. Anyway, great to meet you. Are you planning on sharing your screen, or do you want to use video, or we could just talk? Completely up to you.
Sure, I could share my screen with you, and
okay.
Let me just see. You're seeing me right now.
Yeah. So
I'll share my
you've been
screen.
in Zoom before, right?
Yep. Here we go.
There we go.
Okay. So I don't know, is there anything specific you guys wanted to talk about today?
You know where I want to start before we get to the markets, Mike? It's interesting to hear where people came from, how they got involved in the industry. I mean, when you were 16 years old and you got your driver's license, did you know you were going to be trading SPOOs? How did it all happen for you?
I'll tell you, I certainly had dreams of trading SPOOs when I was 16 years old.
Really? Why?
So it was weird because when I was a kid, my dad wasn't in the market. He wasn't a trader, or he was just a regular guy, and he owned a business, but he invested a lot. And so he would always tell us about the stocks that he owned for me and my brother, stuff for us when we would go to college. And, so I got an interest just because it was interesting to kind of get a feel for it. And then I remember one time just being sick from school, laying on the couch, and I caught CNBC when I was about 15 years old. And I was like, oh, this is interesting. I think I own IBM, and I saw it was changing price. I was home for a week, and I kept watching it go up and down, and I got really interested in it. And I was kind of hooked on the market since then. And I took over my account when I was about 18, and I traded my way through college during the dot-com bubble. Cool. So I was able to.
Where'd you go to school? Where was it?
I went out here at Long Island University in Old Brookville, which is a local school over here. And, I was able to basically trade my way through school. Although the environment was very favorable. I got my first job when I was 18 working in the business, just as a cold caller.
Yeah.
And then I, moved on.
How do you like that Kohl's directory? I think I'll call it B's today.
I don't know what it's called today, but I used to call out of the industrial manufacturer's telephone book. This is 1997.
All right.
And we would, you'd sit there and you would make 400 or 500 dials a day, and you would do
There's big money in that book, man. Right?
Yeah, my boss told me we would be looking through the book. He'd be like, you only call vice presidents and higher. And so I would go through, and then when I was young, I was 18. What do I know, right? So I'd be like, who was that person you put me on the phone with? They have a $3,000 account. I'm I don't know. It said vice president. What do I know?
Yeah.
They own Herman Miller from 20 years ago. What is that?
So you love trading, but your entree to the business was being a salesman. You knew that wasn't for you in a short period of time.
Definitely not.
Okay, so I'm looking at your setup here. Any major influences for trading, for technical analysis, any mentors that you had, or are you pretty much self-taught, trial and error, got kicked in the teeth, whole thing?
It's all a little bit of everything, to be honest. And it's funny because as I've gotten older, I'm 45 now. And as I've gotten older, my styles have sort of matured with me. And,
just wait, man.
I've slowed down a lot. And, I think for me, when I was a senior in college, that was 1999, 2000, the market we were doing, I was really just trading on a regular basis through my broker at that time, paying whatever, $100 or $200 a trade. Yeah. And I got really and the thing at that point in time in the 90s, as you know, we had, charts, and we were just kind of getting, real-time quotes, and you just got the T1 line maybe in your house.
Right.
And, the access to fundamental information was very hard to get. And so what I learned how to do from that age was to look at charts. It was very easy to look at a chart and look at things and see what the market was doing and try to figure out what was happening from the chart perspective, because access to fundamentals was very challenging to get. And so then when I graduated college, I worked on a desk where we sold, where we took care of all the venture funds that were distributing shares to their shareholders from the 2000, 2001. So these were all the companies that were just coming public. And so we were doing like restricted stock sales, and we were moving, stocks like, I don't remember some of the names. They were some of the ones that aren't around anymore, like Tipco, and I'm trying to think of a couple back from the day. And then
so that was kind of salesy too, wasn't it? That wasn't trading.
Well, I
was
a trading assistant, obviously, at that point, and I wasn't really, we weren't selling. They had people that went out and they got the venture fund business, and we were more of on the receiving end of the orders. But again, these were big sizes, and you were always trying to work in and out of them. And
were they liquid?
No.
The spreads were what, 10%?
Yes, and especially, in the NASDAQ in 2000, 2001, you could remember what it was like, right?
Yeah, right.
And so it was, it was a learning experience. And from there, I got a little more analytical, because I went to work at Thomson Financial for a couple of years, and there I was working with biotechs and telecom companies. And in that capacity, I was working directly with the IR team of the publicly traded company. So I was getting a little bit of a different viewpoint on things, on how I was really beginning to learn the fundamentals of the business and how things really worked. So at that point, I was able to start combining my technical skills with my fundamental skills. And then I went on to work on a buy side desk at US Trust for a few years, trading equities. And then I went on to work for the next 10 years at a long short shop, trading basically everything under the sun. But my focus was domestic US equities and international equities. In that case, I was trading, overnight on a regular basis, large size. And that was really where I learned everything. And then when I got tired and I couldn't do it anymore, I had 2 kids and the commute was killing me, I decided to start my own thing and kind of combine all of my experiences and trying to help teach people, and, started a long-term investment portfolio, because I found that in time, people who really tended to do well, the less they traded, the
less is more.
Yeah.
Less is more.
And the more conviction you have, sometimes that's the better way to go about than trying to make these, really quick trades, because you tend to win and lose a lot on them. And so that's where I've been.
So you're patient for the high level conviction trades where you have confluence and you build the case like an attorney, that there's so many reasons why you take the trade, that you go in, instead of saying, I hope this works, you go in and say, Mr. Market, I've done my work, prove me wrong.
Right. And I use
the attitude.
Yeah. And I try to stick to things that I can either have an edge on, or, I can look at the charts and fundamentals and the options market and be like, look, this is what's happening in options. They're betting this thing is going to go up,
Okay, you look for big option sweeps to give you a hint for
so
directional trades.
What I actually do is, I can show you really quickly. I use something called Trade Alert.
Okay.
And so what this is what I do every day is I look in the open interest changes. I'm not watching the options market intraday. I'm looking at the open interest changes, because I want to see what's real and what's noise, right?
Yeah.
And so, like, this stood out to me today was, Netflix, for example. Someone is trading, the 320 calls and the 320 puts for the same expiration date. I'm assuming this is a trade on earnings, right?
Yeah.
And what you do is, when you go in and you look at what the trade was, it shows you they bought 10,000 contracts at the 320 strike for $31, $32. and they sold the puts against it, right? So that's a bullish trade, right? Someone's betting that Netflix is going to be, $320 plus $13.60 higher by the time you get to the option expiration date, if not sooner. And then what I would do is I would come and I'd look at the chart and I say, oh, the stock is getting close to, breaking out here. There's a gap to fill up here at 353. Maybe that's a stock that can still go higher.
Got it. All right.
And that's sort of the approach I would take.
Yeah. And, that's interesting because some of the best traders I know on the equity side really do pay attention to option sweeps to give them, to get their attention about something. And then they apply what they know to executing. So you came in here with the S&P chart, Michael. So tell me, you have conviction about what's going on here after the CPI yesterday? I know we've been short-term rejected from 61.8 fib level, and we're still higher on the week. Where's your head at on the market here?
So I've been bearish on the market overall since the fall of 2021. And this move that we've been sort of looking at more recently has been frustrating for me, because the setup going into the end of the year seemed like there was a really good opportunity to move down. What I like to track on top of all this other stuff is liquidity. And what I do is I look at reserve balances, and I look at them versus the S&P 500. And I knew going into the end of the year, we usually see a spike in reverse repo activity, which works to drain liquidity out of the market.
Yeah.
And so I was looking for a big sort of move down in reserve balances going into the end of the year. And as you can see in this chart, typically when you get a low in reserve balances, you get a low in the S&P 500. And
we're
JP
making
Morgan,
new lows.
You get new lows, right? And the JP Morgan collar sort of held everything up, I think, which really disappointed me.
Okay. All right. I really appreciate you sharing this, your methodology with us, because, I guarantee you that people that see this or watching it live right now never thought to look at reverse balances. So you're looking at monetary conditions. Is it favorable for risk or is it negative for risk?
Right. I mean, in this market, as you can see, going since the beginning has all been liquidity driven, right?
Yeah.
When reserve balances have been rising because of QE, the market was rising very steadily. When there were big dips, the market tended to pull back. And really, if you go back to the beginning of, the whole thing, you'll see the relationship is very strong, right? And when reserves were dropping in the 2017-18, you had a lot of volatility in the market, right?
Yeah.
And then it wasn't really until the Fed started to pump again at the end of 2019 that you started to get that move higher. So, my mindset is that the Fed wants liquidity out of the market. The Fed wants financial conditions to be tight. That's going to be a headwind for stocks really having any sort of meaningful rally, which is why I think we've gotten these really big, sharp rallies, but we can't really get through certain levels, because once we get to a certain point, the liquidity dries up and reverses the other way.
Is a weaker dollar providing a monetary loosening? Is that in a way?
So if you look at the they publish this data once a week. Chicago Fed does it. It's called the Chicago Fed National Financial Conditions Index.
Okay.
And what you see here is that when financial conditions are tightening, so when these black lines are rising, it's an indication of financial conditions tightening. And when they're falling, it's an indication of financial conditions easing. And so when you dig in a little bit closer, you can see that when we've been really tight on financial conditions, market's been at the lows, right? And as we've been easing in financial conditions, you can see the market's been rising. What causes this to happen is changes in the dollar index, which obviously are now beginning to weaken. Because when you can see, I have a messy chart here, but the dollar index has basically been rising, I mean, since Jackson Hole of 2021.
Right.
And as we've gotten, higher, stronger dollar, what I tell the subscribers of my services, stronger dollar, higher rates, wider spreads, lower S&P 500, higher VIX, all work to tighten financial conditions. And then, of course, the inverse, right?
So if we got a dollar rally and, it's pretty crowded on the bearish dollar side right now, especially euro. I'm thinking that maybe even today we might be making a turn. Does your work show any possibility of at least a bear market rally, which we really haven't seen any kind of decent retracement all the way down? It's been down, 12, 13 big figs in a short period of time.
On the dollar, yeah. And I just wanted to show you quickly, this is the dollar and the S&P basically inverted, right? I mean,
Okay.
you can see the relationship.
Yeah.
And when you dig in closer, you can see it's, inversely related. I don't know if it's how strong the correlation is, but there's clearly a relationship between the two.
Yeah.
And sort of, the thing is, what I try to do when I want to figure out where my currencies are going is I just try to look at the spreads between, some bonds. And, the spread between the 10-year US and the 10-year German bond has collapsed, right?
Yeah.
So you've gotten strength in but the point is too, is it's also getting towards a point where, how much more is it really going to collapse? And that could be one reason why you could see the dollar, rebound a little bit.
Yeah.
And you look at it versus, I did that the wrong way.
So are you strongly neutral S&Ps here, or would you be short against yesterday's highs? Because, yesterday's highs also attacked that downtrend line that the whole cosmos is watching from the January high and just missed it. I think we could back away from it again, and maybe the third time we get up there will be the time we finally break out of that.
So this is the chart I have on the dollar, and I've been telling my subscribers I don't actively trade the S&P or anything like that anymore. I just don't really have I don't have the fortitude anymore to do it. I just like to sort of sit back, buy and hold. But I use all of this because I like to help to use it into my analysis in terms of where I think the market is going. Do I want to maybe sell some stock? Do I want to maybe buy something?
Yeah.
And plus I have I write a lot. I have a subscription service. I provide, people information and thoughts. And so what I've been sort of watching here on the dollar is this trend line, this red one.
Yeah.
And, you can see we came back yesterday, tested it.
Yeah.
And so I'm thinking that if we can stay around this 103 region, 102.5 to 103, I think we'll be okay. I really worry, though, if we start breaking meaningful below, because you can see we start running out of support again until you break below 100.
Yeah.
And the thing that I'm most worried about is this one, which is the Chinese yuan versus the dollar.
Yuan, yeah. Okay.
You can see this was a major support level right in here at 677.
Yeah.
Which sort of broke. And there's a lot of congestion in this region. Yeah. But this is sort of the big area that needs to hold, because you can see the drop could be pretty significant, right?
Right.
And then, and the thing is that what I think the market's not really paying attention to is this idea that a lot of the reason why you've seen inflation come down is because of the strengthening of the dollar versus the yuan. We get a lot of goods from there, right? In China. Plus the strong dollars help to contain commodity prices and copper prices. This has been something I think is really interesting, is copper has just been ripping higher, and copper is a leading indicator. Copper. Yep. Copper is very much a leading indicator.
So people are believing this China reopening without a stumble right now.
If you look at iron ore prices, you certainly think so. Look at iron ore prices, just 62%, 63% off the low
in a couple months.
Yeah, look at Hong Kong, right? I used to trade often. I used to trade all over the world, and Hong Kong's up 50% since November 1st, right?
And all the Chinese stocks have been the stars,
right?
In the last few months.
And so, the market, at least out of Asia, seems to believe that this is real, and sort of the tell also is Australia. I mean, Australia 200 is up. I mean, it's almost at its highs. I
Well,
mean,
the FTSE is at new highs.
yeah, I was looking at, oh, now it is. Yeah, I mean, I was looking at it. I'm stunned that you're seeing such strength in these markets overseas when, the economy is supposed to be falling apart and things aren't supposed to be that great. But I was doing some analysis. I don't know if we're going completely off topic or not.
It's great.
But I was doing some analysis last night. Let me see if I can find these. Anyway, I was doing some analysis last night, and basically what I was seeing was that a lot of what we've seen, the strength in Germany, the strength in Australia, the strength in the Dow, all related to a big influx, a big rotation into financials, materials, and industrials. And that's all it's been. Basically, the way I'm looking at it is just that the tech sector has been sold, and the money's been rotating into financials, industrials, and materials. And basically what's interesting today is that, you have financial selling off after these big banks. And so I'm curious to see if we start rotating out of those names and what that does to the overall indices. I just wanted to show you quickly. This is the chart of copper to the ISM prices paid index. I don't know how well you can see it. I'll make it darker.
No, it's fine.
And you can see that you can see the inflationary impulse it creates.
Yeah.
So I'm not basically after yesterday's CPI print, I was looking at everything and I'm like, you have commodity prices that are on the verge of breaking out from the China reopening. We have gasoline prices, which really were the main driver of some of the declining, CPI prints, which are now showing signs of coming alive. So I'm not really a believer that inflation is going to vanish. And so I tend to agree that the dollar is due for some sort of rebound here.
And 10-year yields as well.
And rates are probably getting a little bit oversold. I mean, this is the big uptrend in the 10-year.
Okay.
And so these are sort of, but I mean, if you look, these are really incredibly important levels.
Yeah,
I mean,
just like the yen.
Yeah, I mean, you could see everything's really like on the cusp of something happening, whether the market is just going to totally reject the Fed's idea of, what they're going to do, and the market and rates are just going to collapse and the dollar is going to sink, which is really going to be a bad outcome, I think, for inflation overall, or the market is just going to snap back and realize that, no, inflation isn't going away. Dollar needs to tighten, and I keep looking at the calendar to see like if Powell is talking anytime soon, because, is he really going to go is the Fed really going to go into a blackout period with this sort of mentality in place?
Yeah.
And
until their meeting.
Until their meeting in 2 weeks, and really let the market sort of run away with this idea that inflation is going to disappear.
Yeah. So the market, who's going to win, the Fed or the market?
Right. And right now, I mean, if we just look at an inflation swap, you can see where they have it at 2% by the time we get to June. So I don't know.
Okay. Yeah, I know. I tell you, Michael, I'm so glad I reached out to you. I want to thank you for accepting the invitation. I know that you have a call coming up, but I do want people to know the best way to get a hold of you. You say you teach people too through your feed. So would it be at Michael Mott CM on Twitter the best way to get a hold of you?
Yeah, I mean, you can just follow me there, and you can send me I always post all of my content every day, everything I write. And then, I post stuff all day long, but I also post links to all the stories I write. So like here, I wrote a story today. Yeah. The Fed
You're on Alpha. What's the name of that?
So on Seeking Alpha, I have
Seeking Alpha. You write on.
Yeah. I write a lot on Seeking Alpha. I have a service called Reading the Markets. And basically I go through this type of stuff every day. And I just post and I write up stories for people, telling them what is going on in the market, what I think. I got into yesterday talking about reserve balances. I showed the breakdown and what the changes were. I do this, and then I was talking a little bit yesterday about the banks. The banks look like they're ready to sort of break lower. And if they do, I think they take the market with them.
I think everyone should follow you for their intelligence gathering and be able to learn, and that you have a giving spirit and you're sharing how you did it. And we all know how much work it takes to really develop your edge. You have to go through a lot of
it's a lot of trial and error. And I've never been afraid. I think, the great thing I think that I've always had is I've always had a natural curiosity for learning more. There's always something to be learned in this environment, in this day and age. I knew nothing about that gamma. I mean, I understood the option market very well for a very long time, but I never really understood how like gamma and all that stuff really drives the market and sort of gets it pegged to certain levels. But man, I spent like 2 years just teaching myself everything I could on it. And now, it's a really important thing to understand. And I took, 5 years to learn about the influences of liquidity in the market. And, it just takes a really long time and trial and error and trying to figure out, what's working, what's right, what's wrong, where are the relationships. And it just really, you just need to want to continue to learn. And I think as long as you're willing to do that, you can really be successful in this business.
We're growing or dying, Michael.
Yeah. I mean, basically, I tried to take 6 months away from this business back in, I don't know, call it 2014.
Oh, come on, man. It's Hotel California.
And I just came right back. You know what?
It's like being in the mafia. It's like being in the mafia.
It's worse. It's like, because you know what? Honestly, though, because where else are you going to ever have a job where the news is changing every day of the week?
Yeah.
Every day you come into your desk, you come to work, you do not know what that day is going to bring, and you do not know what the news events that are going to drive it.
That's the beauty.
So what else are you going to do? Go somewhere and have the same reports you're looking at every day or doing the same? I can't do it.
I know. Well, I go to TA, Traders Anonymous. At first, I, wanted to trade, and now I have to. Anyway, really great meeting you, my new trading warrior brother.
Thank you. Have me on anytime. I'd be happy to help you and happy to share my experience with you guys.
All right, Michael. Thank you so much, man. I'm rooting for you here in 2023.
Thank you.
Everyone who reads your stuff and hears your voice.
Thank you.
All right, Michael Kramer, everybody. So everyone have a great weekend. Don't just count your pips, count your blessings. And you could join the team in, 18 minutes for the morning edge. And thank you, Michael, for giving us and sharing your edge with us today.
Thank you. I hope you found it helpful.
I did, man. Thank you, buddy.
Thank you. Bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.